the vehicle elective pay. Um, and so that's what we're going to be focusing on today. If we could go to the next slide, please. So today we are going to run through quite a bit of information. I'll run through some housekeeping items, and then we will hear from Cassie Rowlands, who is the consultant assisting the IPA in this work. Cassie has supported similar efforts in multiple states and is an expert in elective pay. We'll go over what elective pay is, which tax credits you can use it for, the eligibility requirements, how recent federal legislation has changed those tax credits and their availability, and the process for using elective pay. We'll also hear briefly from the Illinois Finance Authority about some resources that they offer to support leveraging these tax credits. And then hopefully have a few minutes for Q&A. And this is all information that we've really geared towards entities that are the owners of the projects. So we'll go through that later, but we will be having an approved vendor specific webinar in a couple of weeks as well. Next slide, please. So just a few housekeeping items. You might have noticed we are recording this, and that will be available on the elective pay website on the IPA webpage. Please remain muted during the entire presentation, but you're welcome to come off mute for the Q&A. And then we do not permit note takers in IPA webinars. So if we do notice any note takers, we will remove them. Next slide. Just a little background on IPA for those who are not familiar with our work. We're an independent state agency created in 2007. We are responsible for implementing Illinois' renewable energy portfolio standard and incentivizing the deployment and development of new renewable energy resources. And so because there are so many federal tax credits that apply directly to renewable energy resources, we want to make sure that Illinois projects are leveraging these tax credits to the fullest extent. And now I will turn it over to Cassie, who's going to dive into the main topic of today and be our resident expert. So Cassie, go ahead.
Thanks, Sarah. It's great to be here with everybody today. Like Sarah said, I have worked on elective pay across a number of states, but this is my disclaimer to tell you that I am not an accountant and I am not a tax lawyer. And I very much encourage you to work with both when you are pursuing these tax credits. So myself and IPA, we don't give tax advice. That is something a CPA can provide you. And again, definitely recommend working with one to pursue these tax credits. So, for those of you who may not have heard of elective pay before, I'm going to give a short overview before diving into the weeds here on using it. Elective pay is also called direct pay. They're used interchangeably, but if you are looking up more information on this on the IRS website, you're going to see it referred to as elective pay because that is the official term. What it is really a mechanism for tax-exempt entities to claim tax credits. So previously, prior to the Inflation Reduction Act passage in 2022, individuals like you and me or private companies could claim tax credits for renewable energy projects. However, tax-exempt entities were not able to do that because they did not have a tax liability. That is now changed, and so for the first time, these entities can claim these credits by filing a tax return, and they will receive a check from the IRS for the amount of the credit. You can combine these tax credits with grants, loans, and other types of funding. So we'll hear about one type of loan from IFA later, as Sarah alluded to. And I know that there are a lot of these projects that are receiving grant dollars as well. And in some cases, you can combine the tax credit and the grant to cover the entirety of your project costs. So this is a huge opportunity. The tax credits oftentimes are, you can claim them for about 30% of the total project cost, depending on the type of project that we're talking about. And I'll get into that in much more detail a little bit later. The important thing to know about these tax credits is they are not like grants in that they are uncapped and they are not competitive. So tax credits are an entitlement. If you are eligible and you meet the requirements of the credits, then you are entitled to that tax credit. You are not competing against others for a like for a grant, for example. And there is no maximum amount where these cap out in most cases. So you can claim these tax credits for as many projects as you place in service or as many electric vehicles that you purchase, for example. And I'll talk about those in more detail later. It is important to note that as a tax exempt entity, you have to own the energy property. So, for example, the solar panels, in order to claim the tax credit on those panels. You do not have to own the building that they are on, but you have to own the panels. So, you cannot be leasing or use a PPA model for your project if you are to claim the tax credit. The projects that are entirely covered by grant dollars will not be able to claim the tax credits if it's a restricted grant. So that's something else I'm going to get into more detail about later, but a lot of times I've seen projects that have been fully covered by restricted grant dollars, and therefore the IRS prohibits you from claiming the tax credits. And then finally, there are deadlines. Your ability to claim the credits is time bound. And so it is too late now to claim credits for projects that were already placed in service in 2023 or earlier, and really for most of 2024. There might be some cases where if your project was placed in service in the latter half of 2024, your entity may be eligible to claim those credits. And I'm going to talk about deadlines and processes later on. But really, we're mostly looking now at projects placed in service in 2025 or afterwards that are eligible to claim these credits. So when I talk about tax exempt entities that can now claim these credits, we're talking about local and regional governments, and that includes their agencies and instrumentalities, which include things like public school districts, transportation authorities, water authorities, housing authorities, other types of municipal entities. It also includes community colleges and public universities, because those are, oftentimes part of state governments, which are also eligible entities. Rural electric cooperatives, nonprofit organizations, so 501(c)(3) or C4 organizations, houses of worship and other faith-based organizations are all also eligible. And there's kind of a catch-all definition here and also really helpful IRS FAQ linked at the bottom of these slides if you're not sure where your organization might fit. So if those are the entities that are eligible to claim these tax credits, this is a sampling of the types of projects that those entities can claim the tax credits for. So the most popular projects that we've seen are things like solar, geothermal, energy storage, EV chargers, and EV purchases. The number of tax credits that can be claimed using elective pay, this method for tax exempt entities, is larger than this. There are 12 tax credits that can be claimed via elective pay, and those are linked in the IRS fact sheet at the bottom of this slide. There are other types of projects that qualify, but these really are the most popular ones that I've seen. I often get asked if energy efficiency measures like replacing lights and windows, installing insulation, things like that can be if tax credits can be claimed via elective pay for those types of upgrades. They cannot. Same thing with small heat pump installations. Those are not things that are eligible to be used with elective pay. Now, I also often get asked, does elective pay even still exist? I thought the tax credits were over, um, and wanting an update as a result of the One Big Beautiful Bill Act that passed over the summer. The answer is yes, they do still exist. The tax credits are still in place. Elective pay payments are still being processed by the IRS. Project ID numbers for those projects, which I'll talk about later in the presentation, those are still being issued. The IRS helpline is still being answered, and there's an IRS specific elective pay specific email inbox that is still being answered. I have seen responses come back from that email inbox same day. So it's very different again from the grant world where some of these things are on pause. The IRS is also hosting monthly office hours that you can go sign up for and talk to a real live person to get help with your elective pay process. So that's important to keep in mind. I will say that while elective pay as a mechanism was not affected by the One Big Beautiful Bill Act, the underlying tax credits that entities claim through elective pay are affected, and I will also get into those changes later on in the presentation. So I talked about a couple of types of projects that you can claim the tax credits for. I'm now going to walk you through which tax credits you claim for which types of projects. So the two electric vehicle tax credits are important and are kind of one of the more frequent ones that are claimed via elective pay. So you have the first line, which is the Commercial Clean Vehicle Credit, or 45W. That is the credit that an entity would claim if it's purchased electric vehicles, hybrid vehicles, or fuel cell vehicles. The maximum value of the credit is $7,500 for passenger vehicles, and it's $40,000 for larger vehicles like, say, electric buses, electric garbage trucks, these much larger weight vehicles. You do have to look into a three-step analysis to determine exactly how much credit of a credit you can get per vehicle. And I've put a link there to the IRS website that is a very helpful way to dive deeper into that. Now, I will note that because of the changes from the One Big Beautiful Bill Act, only vehicles that were acquired before September 30th of this year can still claim this credit. So that's important to note for any entities that may have purchased vehicles earlier this year. Those can still be claimed, but anything acquired after that cannot. The second popular tax credit for elective pay eligible entities is the Alternative Fueling Infrastructure Credit. So this is used for EV charger infrastructure. The value is based on your investment in the project. So it is an investment tax credit and it's based on that amount. And you could receive up to 30% of the total investment in the charger, up to a maximum of $100,000 per um, charger port. This is only eligible, EV chargers are only eligible if they're in a certain census tract for rural and low-income areas. I will say that I've checked, and a large part of the state of Illinois are included as eligible areas on that map. So you can actually click that link, go to the map, and insert your address to check if your census tract specifically is eligible. So I would encourage you to do that and see if any chargers you're installing are in the eligible areas. But there are two more caveats to keep in mind for these EV chargers. For number one, you can receive up to a 30% tax credit based on the total cost of the charger installation. However, for this credit, the installer needs to comply with specific labor rules in order to get that full 30%. Otherwise, you're only going to get a 6% credit. Um, those labor rules are also going to apply to the next tax credit I cover, and we'll get into more details on that in the AV webinar that Sarah mentioned as well, because that's really something on the installer side. They'll need to pay certain wages and use apprentices in order for you to be able to get that higher credit. The second important point here is just that you can only claim this credit for EV chargers if they are placed in service before June 30th of next year. So another new deadline as a result of the bill passing over the summer. I'm going to move now to probably the most important tax credit that you all have likely have projects eligible for, because this is the investment tax credit. It is used for things like solar, wind, geothermal, energy storage, etc. So here, given IPA's focus on solar, this is really the tax credit that we are focusing on. We wanted to let you know about the EV credits, but certainly this is right within IPA's wheelhouse. So the investment tax credit is based again on the size of the project owner's investment. So it can be 30% of the project costs, and I'll go over that in a minute. But for large projects, the labor rules that I mentioned earlier do apply. Um, I will note that there are a host of new restrictions and regulations and deadlines that come with this tax credit for solar, and I'll go over that in more detail later as well. But first, just want to provide an example of how this tax credit works. I've got this example here of a church in Detroit, Lord of Lords Ministries. They've got a 14 kilowatt ground mount solar project on their property. The project cost about $31,000, and they used this investment tax credit to claim a 30% credit on the cost of the project. So they filed for elective pay, and they received a check for the amount of that credit, which was a little bit below $13,000. But because the IRS actually took so long to process this payment, they were really one of the first ones to claim this tax credit after the Inflation Reduction Act passed. The IRS actually had to pay them interest. So there is a silver lining when some of these checks take a little bit more time, is if the IRS does owe you interest, and you may see a check that is a little bit larger than the tax credit you expected. All right, I'm going to just provide one more example. Like I said, there is no cap on these tax credit amounts, and so they can be used for small projects like that church example. Here in North Carolina is an example of the rural electric cooperatives in the state installing a very large battery project across multiple sites in North Carolina. 40 megawatts of battery storage. This was a more than $50 million project. They used the same tax credit, and they received a check from the IRS for $10.4 million for their elective payment amount. So this credit is really for projects of all sizes. It is a very popular tax credit. And just a few examples of how elective pay is bringing these dollars back to these tax-exempt entities who really wouldn't have gotten it before. So taking a look at calculating the amount of the credit for your specific project. So for things like solar, geothermal energy storage that are using the investment tax credit, small projects under 1 megawatt are always going to be a minimum 30% tax credit. For projects over 1 megawatt, um, the installer needs to comply with those labor rules I mentioned earlier, the prevailing wage and apprenticeship rules. Otherwise, the credit is only going to be 6%. So in order to get the 30, you'll want to talk with your installer on those large projects and make sure that they are aware of these requirements and able to comply with them. Again, I mentioned this earlier, all EV chargers will also have to comply, installers will have to comply with those labor rules. Otherwise, they're only going to get a 6% credit. So this is the rules around calculating your base credit or your minimum credit amount. You can also add what are called bonus credits on top of that. So these cannot be claimed on their own. They can be added on top of the investment tax credit, for example. So if you have a solar project and it is a smaller solar project, so it is going to automatically be a 30% credit. If you are, for example, located in what's called an energy community, this could add an additional 10% on top of your credit to bring you to a 40% tax credit. The energy community's bonus credit is geography based, so you can again check a map that is made available online to see if your project is located in a census tract that qualifies. There are, I think, quite a few census tracts here that I've highlighted. The pink and the green areas qualify across Illinois. And so if your project is located there, again, it is automatically another 10% on top of your base credit amount. So this is really areas where there are former fossil fuel infrastructure shown on this map, and also those paired with certain unemployment rates are what determine if a community is considered an energy community. The other part of this bonus credit is that brownfield locations can also qualify as an energy community. They're just not located on this map because you'll need a study, and that is very site specific. The second bonus credit is the domestic content bonus credit. So this is for incentivizing projects that use made in the USA components. If your project uses equipment that meets these requirements, then it can get an additional 10%. A very important special note here for the large projects over 1 megawatt, if it does not meet the domestic content requirements, it actually gets a reduction in its credit amount. So this is specific to elective pay projects owned by tax-exempt entities. If those large projects do not meet the domestic content bonus requirements or bonus credit requirements, and they started construction in 2025, they'll get a 15% haircut in the tax credit amount. If those large projects don't meet this bonus credit and they start construction next year, the entire credit amount will be eliminated. So it is a really important one for those big projects to look at. For smaller projects, this is simply a bonus. If you meet it, you get the extra 10%. And finally, there is a third bonus credit called the Low Income Communities Bonus Credit Program. This is for small wind and solar projects in low income and tribal communities. This is the one exception to the rule about being uncompetitive and uncapped. This bonus credit is one where the project owner has to apply to the Department of Energy, receive an allotment, and actually wait to place the project in service until they've received the allotment, and then they can move forward and claim this additional 10 or 20%. Oop, I think I have just thrown us out of order. 1 second. Apologies. I'm not sure how I did that. Okay. Sorry about that. So I'm going to talk quickly about combining different types of funding with your tax credits. So earlier I mentioned you can combine grants and loans and other types of funding sources with these tax credits that you would be claiming through elective pay. The key restriction here on combining tax credits with grants is the amount of the restricted grant plus your tax credits cannot exceed the total project costs. So, what the IRS has said is if you have a restricted grant, meaning it is restricted to purchasing the equipment you'd be claiming the tax credit on. So, if you have say, a federal grant or a state grant or even a philanthropic donation that says you must use these funds to purchase solar panels for your project, then this no excess benefit rule is triggered. And the IRS has said that amount of grant dollars plus your tax credit cannot exceed your total project costs. So they don't want you to be able to double dip or basically make money off of the grant and tax credit dollars that you're receiving. So I've got here an example of a project that's using grant and tax credit dollars in their capital stack. We're just using simple numbers here. So say the total project costs are $100,000 and say they have a grant for $70,000. It's a, say, small solar project, and so they automatically can expect a 30% tax credit of $30,000. This really is the ideal amount here. You're fully covering your project costs, you're using the full amount of your tax credit, and there's nothing left for excess funds. If this project was, say, in an energy community and eligible for a 10% additional bonus credit for a total of a 40% credit, the IRS would see that you then have gone and increased the amount of funding you have to $110,000, exceeding the project cost by that amount, and they would cut your tax credit. So that would be cut back to only give the project owner the 30% tax credit. So you will have to report to the IRS how much grant dollars you have going towards a project. They will limit the amount of your tax credit so that you don't exceed 100% of your project costs. A note here to say that any municipalities or school districts using tax-exempt bonds to fund their projects will trigger a haircut in the amount of the credit as well. It's based on how much of the project you're financing with tax-exempt bonds, and it will provide a haircut to the tax credit amount based on that percentage. So if you use tax-exempt bonds to cover 10% of your project costs, your tax credit is going to be reduced by 10%. It maxes out at 15% though. So if you use tax-exempt bonds to say cover 25% of your project costs, it's only going to reduce the amount of your credit by that maximum 15%. I keep hitting the uh, forward button going too far. Apologies. So those are the primary requirements around the top tax credits that elective pay eligible entities claim. There have been changes to those tax credits, like I said, as a result of the One Big Beautiful Bill Act. And a lot of the changes that are very important are around the investment tax credit. I mentioned the two deadlines that are relevant for the electric vehicle tax credits. There are new deadlines for the investment tax credit, but there are other additional changes that I'm going to talk about here. So the first is that there are new regulations for use around many of the tax credits, but certainly the investment tax credit. So these regulations, you may have heard them be referred to as the prohibited foreign entity rules or the foreign entity of concern rules. Generally, folks are using those terms interchangeably to refer to these new restrictions on projects that involve entities and materials from China, Russia, Iran, and North Korea. So if the restrictions are that if the entity trying to claim the credit is a prohibited foreign entity from one of these countries, they cannot claim the credit. If the entity claiming the tax credit makes payments to prohibited foreign entities from these countries, they cannot claim the credit. And thirdly, if the projects involve materials or components from these countries up to a certain amount, then the project cannot claim the tax credit. And so that last one is a huge concern for a lot of folks looking at projects where these new regulations will apply. Um, there's a couple of ways to think about this. The first being the regulations on this are actually not out yet. The law was passed with these rules, but the IRS has not put forth the regulations that it needs to outline how to implement these rules. So there are still lots of questions around these, and nobody really has all the answers. The second point to think about here is that these new regulations that again limit who can claim the credits and limit the types of materials that can be used in these projects primarily only apply to projects that start construction January 1st of 2026 or later. So, if your project has already been placed in service, or if your project has started construction already, or does so in the next, 27 days, then you mostly don't have to worry about these credits or new regulations. Now, what does it mean to start construction? If you have a small project of 1.5 megawatts or less, you can simply pay or incur 5% of the total project costs, and you've started construction. For very large projects, you really need to begin physical work at the project site in order to be seen as starting construction in the eyes of the IRS. I know that I worked with IPA to have a look at a lot of the Illinois Solar for All and Illinois Shines projects that have been underway, and I did not see any projects over 1.5 megawatts. So this easier test for small projects starting construction is certainly, I think, what the majority of you may be looking at if you have not already gotten under construction or placed in service. This is definitely something to talk to your installer about and have in mind if you've got any future projects going forward that would start construction January 1st or later. A couple new expiration dates for the investment tax credit. So, wind and solar have expiration dates that came about again as a result of the bill that passed over the summer. Uh, the wind and solar projects that begin construction after July 4th of next year are on an expedited time frame and need to be placed in service by the end of 2027. If the projects begin construction before July 4th of next year, they don't actually have to be placed in service by the end of 2027, but they do have to be placed in service in within 4 years. So the next kind of really key deadline after December 31st of this year is this July 4th deadline next year. And again, the beginning of construction definition here is really important for knowing if you're on an expedited timeline here or not. Geothermal, battery storage, and other types of projects that claim the investment tax credit are actually good through 2035. A lot of folks think that some of the tax credits for clean energy writ large are going to be gone, but for these really key technologies, which I understand are coming within the remit of IPA, are going to still be available well through 2035. And that is something certainly to celebrate and to look ahead to as something that can be used going forward. I am going to briefly go over the process here. These slides have a lot of detail, primarily because I want them to be a resource to you to look back on and reference when you're going through the process. They have a lot of links to helpful information and resources as well. So there are 4 key milestones when you're actually getting ready to claim your elective payment. You really can't start any of the process until you've placed the project in service. So that's step one. The second step is completing a process on the IRS website called pre-filing registration. The third step is completing a tax return and filing it with the IRS. And then, of course, finally, you will receive your elective payment. There are a number of steps in between those milestones that need to be met. So, after you've placed the project in service, you want to make sure you're identifying the tax credit that you're going to claim and just doing your due diligence to see if any of the bonus credits are ones that you qualify for. You'll then want to determine your tax year, your filing deadline, and your target pre-filing registration date. And you're going to want to gather the information and data that you need before you actually get to the pre-filing registration process. So step two here, 1.2 here is about determining your tax year and your filing deadline is really, really crucial. And unfortunately, the deadline to file is not April 15th, like our own taxes. It is a little bit more complicated. And so stick with me while we walk through that next. So, if your organization has filed a tax return or a Form 990 in the past, then it has established a tax year with the IRS and you have to use that tax year. Nonprofits do have to submit a Form 990 each year to the IRS, so that will establish the tax year for your nonprofit. You certainly want to check with your finance or budget team regarding your entity's filing history. If you filed a tax return in the past to claim an elective pay tax credit, then that will also have established a tax year with the IRS. If your organization has never filed a tax return or submitted a 990, then you can choose your tax year based on your organization's fiscal year or the calendar year. This is the part here where I was mentioning about the ability to claim credits is time bound. You can only claim tax credits for projects that were placed in service in your most recent tax year. So if your organization's tax year, it matches the calendar year, January 1 to December 30th, then you're looking for projects that you placed in service only in that most recent tax year. So, um, like I said, it is not, April 15th is not the deadline that we're using for elective pay. The deadline to file your return and claim your elective payment is based on the final day of your tax year. So, the deadline is the 15th day of the fifth month or 4.5 months following the end of your tax year. So if we look at some of these example tax years here on the left, say you file your 990 on a calendar year basis, or simply it's your first filing and you want to file based on the calendar year, just looking at this first row. 4.5 months after the end of this tax year is May 15th. That's the filing deadline. The IRS recommends completing that initial step, the second milestone of pre-filing registration, 120 days before that. So that would be January 15th. Now, that's not a hard deadline, the pre-filing registration piece. That is what the IRS recommends. You give them that amount of time because they have to turn around after you do the pre-filing registration and issue ID numbers for your projects, and then you will use those ID numbers on your tax return. So you want to give them as much time as possible to process that pre-filing registration and issue you the ID numbers. So if your filing deadline on a calendar year tax year is May 15th, you can request a 6-month extension and push that out to November 15th. That would therefore also push out the deadline by which you should be completing the pre-filing registration to July 15th. You can follow this kind of same logic for each of these other types of tax years, a July to June or October to September tax year, just based on these same principles of the deadline being 4.5 months after the end of the tax year date, and the pre-filing registration recommended deadline being 120 days before that. Here's some data and documentation you'll need to collect in order to complete the pre-filing registration on the IRS portal. You will importantly need an ID Me account here to be able to log in. There is a helpful IRS guidebook that you can find here that will walk you through the pre-filing registration process. Once you complete that, you'll want to keep checking back in to the portal to check if your ID numbers have been issued. And then you'll want to provide your CPA with those project ID numbers and other relevant project information so that they can file your tax return for you. Once they've filed the tax return, you can expect to receive a check from the IRS 45 days or more after you've completed the tax filing. Just from my experience in the past couple of months, I've seen it more in the realm of 60 days. And like I said earlier, any elective pay checks that are received more than 45 days after filing incur interest. So I'm seeing projects receiving checks in the 60-day range, receiving a few $100s worth of interest. If you have not received your check after 60 days post filing, you'll want to get in touch with the IRS and inquire about your payment. There have been many, many cases where the IRS has issued letters to elective pay eligible entities saying, no, you're not eligible. And then there's certainly been some complications with entities getting similar letters when they filed an extension. This is normal. The IRS systems have not been well set up to manage tax returns from tax-exempt entities. So this is something that is very common and a lot of time is just sorted out by getting on the phone with the IRS and having them take a second look at your case. Just a couple quick notes here on State of Illinois resources before I turn it over to Claire. So IPA, we are going to be doing outreach and trying to provide some more education and webinars on elective pay, just because the opportunity here really is huge. Sarah mentioned we're going to be having an upcoming webinar for approved vendors, so you should be receiving information about that this week. If you are interested in more resources and information on elective pay, if you've got questions about specific projects that you're seeking elective pay for, you can contact us, and I put the link here. We will be partnering with Lawyers for Good Government, which is a national nonprofit, and sending folks through their elective pay sprint hub for any very complicated cases. Some of these rules and things could get a little challenging, and so we're really glad to have their support. As Sarah mentioned, IPA has an elective pay website, and we will be posting the slides and the recordings there, as well as other resources that we may come up with. But please do feel free to reach out to us for help. And now I'm going to pass it over to Claire just to talk about IFA's loans related to elective pay.
Thanks, Cassie. I won't take too long because I do see that there are some questions in the chat and want to make sure that we have time for Q&A. The Illinois Finance Authority offers a loan program that was specifically designed to work with the tax credits and the direct payments that Cassie just went through. This loan program is funded through a U.S. Department of Energy grant that was given to the Illinois Environmental Protection Agency, or IEPA, and was then passed through to IFA to manage the loan program. We can go to the next slide. So this is a This offering is a low interest loan program that is available to nonprofits, municipalities, other public organizations such as schools, affordable housing organizations, commercial building owners, clean energy project developers, anyone that owns or can do a project on a building. And these loans are for energy efficiency improvements to existing buildings, so not any new construction or community solar has to be tied to one building. And the main product that we offer is a bridge loan specifically designed to bridge the gap when you wait for the tax credit. So as Cassie just mentioned, you don't get the direct pay or the tax credits until after your, 45 to 60 days after you file your tax return, which is often, many months after the project has been completed. And we understand that there is a need for upfront financing in order to get the project off the ground in the first place. So we offer a bridge loan where we will provide a loan equal to the amount that you are getting from the direct pay or the tax credits upfront. It's a short-term loan, and the intention is that you pay us back upon receipt of that direct pay credit or tax credit. Understanding that, some of the solar and wind credits are phasing out sooner. This bridge loan is actually open not just to direct pay and tax credits, but also to Illinois Solar for All incentives, other state of Illinois grants you might be getting, Ameren and ComEd rebates, other grants or incentives, anything that you're getting sort of after your project is complete, and that you could use to pay back a loan, we will give you an upfront loan for. We can go to the next slide. So again, these are the entities that are eligible for this loan. It's pretty much anyone that owns a commercial or multifamily building with 5 or more units, or if you're a developer and you're working with someone that owns the building, that's fine too. The only type of building that's really not eligible for this program is single family residential, or multifamily that's less than 5 units. We can go to the next slide. So our program is funded through, again, the DOE grant. It's funded through the Energy Efficiency Revolving Loan Fund. And so in order to be eligible for our loan, the project has to address an energy efficiency component. So solar projects on their own, if you're looking to get the solar tax credits, are not eligible for our loan product. But if you are pairing that solar project with energy storage, which, as Cassie mentioned, is also eligible for tax credits or direct pay, or you're pairing that solar with other energy efficiency improvements like lighting upgrades, HVAC, we can give you a loan for your project. I also want to point out that, as Cassie mentioned, geothermal tax credits have a much longer runway than the solar and wind credits. And geothermal does count as an energy efficiency technology and meets that energy efficiency requirement for our loan. So if you are interested in doing a geothermal project, that's really great for our program because it's both eligible for the direct pay tax credits and meets our energy efficiency requirement. Additionally, any improvements that are funded under our loan program have to be recommended in a qualifying energy audit. There are lots of free or reduced cost energy audits available out there, either through your utility from ComEd or Ameren. IEPA also just released a round of grants for free energy audits, and I will put that link in the chat as well. But you will need to get an energy audit done in order to qualify for our loan. We can go to the next slide. And then just briefly, here are some of our loan terms. So we will give loans ranging between $50,000 to $1 million. Again, we will match the amount of incentives that you are getting from either direct pay tax credits or Illinois Solar for All, Ameren, ComEd, whatever that combined number is, up to $1 million. It's up to $1 million per building. So if you have multiple buildings and multiple different projects that you're working on, we could do multiple up to $1 million loans. It's intended to be a short-term loan, again, in order to bridge the financing gap that you have. So ideally up to 24 months while we wait for you to get those credits or incentives, and our interest rates are going to be below market between 3 to 6%, depending on what type of entity you are. And And there will be no monthly interest payments. It's just that the principal amount plus interest will be due 30 days after you receive any of those incentives or credits. One other component of this program is as it's a federal component, or as it's a federal program, all projects have to comply with the Davis-Bacon Act and prevailing wages under both the federal act and the state of Illinois Prevailing Wage Act. So I think that's all of my slides, but just this is a good program for you to sort of braid and use in conjunction with tax credits and kind of use them as a way to get upfront money for your projects. So if you have any projects that you think might be eligible for this program, please feel free to reach out directly to me. I will put my email in the chat.
Thanks so much, Claire. So we have some questions in the chat that are really great. I think we have time to cover all of them. I would like Cassie to weigh in on some of them. Um, I think the first one, I'm just going to read them out, is whether the requirements about combining the tax credit with grants is just grants, or if other types of financing, such as payments for renewable energy credits, which is the programs that IPA runs, would kind of fold into that calculation as well.
Great question. It is for tax-exempt funds, and so not sure if Rex would fall into that category, but
It's
that's
actually, yeah, that's a good question. I'm not sure either. I believe they do count as revenue for the project. So I would assume that they are taxable funds. But I can look into that and maybe once we have an answer, add something to the elective pay website on our website.
yeah.
But as far as I know, I have not encountered anything suggesting that the funds from the Rex are tax exempt. Um, and then we have another question about whether uh, the size limit for the safe harbor and for starting construction applies to the entity or if it is by project site. The example is for if a city, municipality, government has multiple buildings that they want to do projects at, does each individual project have to be below the threshold or does the aggregate size have to be below?
Great question. So the IRS is going to look at your multiple sites and look at a few different factors to determine if they together are considered a single project. Some of that might be whether they are bid or procured under one single procurement, if they use the same installer, if they are financed and they are financed jointly, if they are on adjacent or adjoining pieces of land. So there's a number of factors that can come into play there. So it really is case specific. But if you want to reach out to us, we could maybe dig into that a little bit deeper and I could pull the information on those specific factors they'll look at.
Yeah, and just a reminder for all of these, please, if you have more specific questions or we're not fully answering, do reach out to us. We're going to be running some office hours on these topics. We'll have additional webinars. We also have our partnership with Lawyers for Government, and they are on tap to offer more individualized support for individual project applications. And so, we have a lot of different resources available, so please do reach out. The next question got some replies and chatter in the chat. Government municipality stating that their CPA has refused to file a tax return, saying that it would be fraudulent since they do not have anything to report. I assume this is probably not the first time you've heard of something like this, Cassie. So there's some people have pointed her to the IRS FAQ, but maybe there are other responses you've seen that have worked in other cases.
Yeah, that certainly is a very important area to send them to. I've definitely come across this a number of times, whether it's nonprofits or churches who use a CPA that says, you're not eligible for tax credits. You are tax exempt. Number one, I would send them the IPA website that we've put up. In part, that is there to provide legitimacy and show that the state is here to try to make sure that folks in Illinois are actually using these tax credits. Certainly would, if you just Google IRS elective pay, there's a whole website there, and the FAQ are incredibly helpful. So it would definitely direct you to all of those resources.
Great. And then another attendee is asking about situations with public-private partnerships and whether there is ways to kind of share the elective pay revenue or receive a portion of the elective pay reimbursement. If you can speak to that.
Yes, there is a specific set of guidance on this from the IRS, and it outlines the rules around a specific partnership and how that would be managed. So if you reach out, we can provide you with that set of guidance, but there are clear rules. Well, I'm not sure if I would describe the rules as clear, but there are specific rules on this setup, and I don't have them all off the top of my head, but they are definitely something I would recommend taking a look at if you've got a project in that realm.
Great. There's some questions about slides and additional resources. All of the slides will be posted on the website that Tori pasted in the chat. She can paste it again for those that joined late and didn't see the earlier chat messages. We the I think the IRS helplines and IRS ways to reach out are likely available on some of the websites that have already been shared in the chat to the IRS FAQ on elective pay. And then in terms of specific information on labor rules, we did have some additional information on labor rules. We are going to focus on that more in the webinar for approved vendors, which is coming up in a couple of weeks. That is kind of more relevant for the contractor or the entity building the project. But if you are not planning to or missing that webinar, please do reach out and we can provide some more specifics on that, or just come back later once that webinar is the recording is posted and the slides are posted to the elective pay website on the IPA website. Someone's asking about the IRS elective pay email address, phone number, office times. I'm not sure, honestly, if those exist. I'm assuming
Yeah,
that they do.
they do.
So, all right, we can
Yeah.
share that as well.
So I'm putting in the chat the page where you go to start the pre-filing registration. If you scroll to the bottom of that, you can see the office hours that you can sign up for. Um, if you are looking to email them about the pre-filing registration part in particular, then you can use the email address I just put in the chat. The phone number I don't have off the top of my head. I'm not sure if it's a specific phone number for elective pay, but I have a hunch it's really just the general helpline.
Thanks, Cassie. That might be the longest email address I have ever seen.
Yep, it is
Um,
indeed.
so definitely write that down because you will not remember that off the top of your head. Well, thank you so much. We're at 4 p.m. Again, this was recorded. It will be posted on the IPA elective pay website. along with the slides. The slides will then have, the links available to click on and follow. We'll be doing additional webinars, and those will be, the registration information will be posted on that website. We'll also, send out announcements through our listservs and encourage our partners to do the same. So we really appreciate your attendance. We hope this was helpful. And yeah, if you have additional questions, please don't hesitate to reach out. Thank you so much, everyone.
Thanks all.